some investors fear there could be a significant stock market downturn on April 2nd. Others are completely ignoring the very obvious risks. Should you be worried? And if you are, what can you do about it? This is Ethan, CFA Charterholder and investment professional, and I'm going to help guide you through that today. Let's start with why some people are so scared about what's coming on April 2nd. Then I'll cover what I think is likely to happen, and we'll end with a clever way to protect your portfolio from a sudden downturn with a lot more short-term upside potential than downside risk. Let's dive in. The tariff frenzy to start the year has already driven U.S. stocks in blue to fall since Trump's inauguration, even while European stocks in red and Chinese stocks in green have risen significantly. Why European and Chinese stocks are doing well has little to do with tariffs, and those are probably topics for another video, but the reason that U.S. stocks are down has everything to do with tariffs. That could get significantly worse on April 2nd and send stocks down much further. So what might cause that to happen? Reciprocal tariffs. To put it into perspective, in Trump's first term, as crazy as it felt at the time, when the trade war ramped up in 2018 and caused a market downturn, tariffs only covered about $400 billion of imports at their peak. Just 2 months into his second term, we already have tariffs in place on $1.4 trillion of imports, and he's just getting started. So what are reciprocal tariffs and how much bigger could they be? Essentially, reciprocal tariffs are the idea that we should be charging everyone else what they're charging us. And most other countries charge higher tariffs than we do. For anyone who passed elementary school, the concept of fairness seems pretty obvious here. So I get where he's coming from, but the reality isn't that simple. We actually tried this in the early 1900s, but it turned out to be way too complicated in practice, and that was over 100 years ago. Nowadays, the world is a lot more globalized, and we have tariffs on about 13,000 different categories with about 180 trading partners. If we wanted to match each country tariff by tariff, it would create about 2.3 million separate tariff rates, which would be a logistical nightmare to implement and maintain. That would be the opposite of cutting red tape and regulation, which is one of the things Trump did to boost the markets in his first term. What ended up happening last time we tried this was Congress adopting the most favored nation policy through the Tariff Act of 1922, which then became required by U.S. law with the Trade Agreements Act of 1934. It's been broadened and tweaked a few times through history, but essentially, it now means that whatever the lowest tariff rate we have on a product is, that's the rate we have to offer to everyone, except if they're covered in a specific trade deal, like the USMCA with Mexico and Canada. And every member of the World Trade Organization, which includes countries that make up 98% of global trade, has to agree to the same principle. So that simplifies everything a lot and leads to broadly lower tariffs, more free trade, more open markets, and generally stronger economies globally. It does create some imbalances, but that's because most countries don't produce the same stuff. For example, Colombia has a 70% tariff on coffee to protect its coffee farmers from foreign competition, but the US hardly grows any coffee beans. So putting a 70% tariff on our Colombian coffee imports wouldn't do much to boost production at our non-existent coffee farms. And getting Colombia to lower their tariffs on our non-existent coffee exports to their tiny economy wouldn't really make a difference either. Mainly, new tariffs would just jack up the price of Colombian coffee for U.S. consumers. Take that example and multiply it by 2.3 million. And you can see why some people fear what could happen in the markets if Trump announces reciprocal tariffs on April 2nd. It could bring significantly higher tariffs and more complexity to global trade, which would not be good for stocks. Even Trump admits there will be some pain. He claims it'll all be worth it because it'll make America great again by generating a lot of tax revenue, bringing back a lot of jobs, and stopping other countries from taking advantage of the U.S., among many other things that I'm going to refrain from commenting on here. Do I have personal opinions about the merits of his claims? Sure, and I'm sure you do too, but a key investment lesson to remember is that regardless of how much you care about politics, your investments don't. If political fireworks are your thing, just go watch the news. What matters for your investments is assessing what is likely to happen, not what you think should happen. In this sense, the only opinion that matters is Trump's, and he thinks tariffs will be great for the United States, so we can expect more of them. And wow, right on cue. I swear I didn't plan this, but he literally just announced 25% tariffs on all car imports to the US right now as I'm making this video. You can see from the timestamp that this just happened. Well, quick sidebar on that. I've seen analysis that a 25% tariff just on auto imports from Mexico and Canada would lead the average car price to increase by around $3,000. And not just imported cars, all cars. Because even cars made in the US get a lot of components from outside the US, so I hope you're not in the market for one. Well, if you needed another reason to take reciprocal tariffs seriously, here it is. So, how big could reciprocal tariffs get? It's hard to assess because Trump has hinted at including VAT taxes, which are charged by every major country except the US. I saw an estimate from Goldman Sachs that just matching tariffs would increase our average tariff by about 2%. But a lot of European VAT taxes are over 20%. So if he included those, there's a serious chance that it would cause a market crash. If you aren't familiar with the VAT tax, it's not a tariff. It's more like a sales tax. It's not like a tariff, and in my opinion, shouldn't be included for two reasons. It's charged to everyone all the same. If one company in the UK buys something from another company in the UK, they'll have to pay the VAT tax. And second, most exports, at least from the EU anyway, are exempt from the VAT tax. You have to pay it, but you can get a refund. So American companies are not generally paying the European VAT tax. European companies are generally paying the European VAT tax. So it's quite different from a tariff. But my opinion doesn't matter. Only Trump's does. And he is considering factoring in the VAT to the calculation. He's also floated the idea of using tariffs to make up for past higher tariffs, which make the potential amounts so high my brain can't even really comprehend. So, yes, it could be really bad. And that's a realistic possibility, so I don't want to dismiss it. But here's what I think will happen on April 2nd. It's all speculation, of course, but he's made little comments here and there about things possibly taking a few months to materialize. And of course, it's physically impossible to implement over 2 million tariffs overnight, so I doubt he'll go full replication with immediate effect. What I think is more likely is we'll get some combination of immediate announcements and announcements of future plans. It could be something like, we're going to give XYZ country 90 days to lower their tariffs to match ours, or we're going to raise ours to match theirs. He could also come out with some sort of marketing campaign, if you will, to educate the country on his views of other countries' unfair trade practices, as he sees it, to try to bring more people around to his point of view. Maybe show the top sectors or countries where there are the biggest gaps in tariff rates, similar to the chart I showed you earlier. Then, I think it could kick off months of negotiations. I'd be surprised if he didn't implement anything on April 2nd, but I don't think it will be quite as bad as the worst fears would suggest. Maybe he could even remove some tariffs, like possibly the ones on Canada and Mexico, to help offset some of the fears from his other announcements. It's all speculation, but I think it's unlikely to be the worst case scenario, and the real action is more likely to happen piecemeal over the next few months, or maybe longer. One scenario that I don't think enough people are talking about is that this could ultimately lead to lower tariffs around the world. Europe has already started talking about it. I think that would catch a lot of people by surprise in a good way and be amazing for markets. It's really hard to say what the odds of that are, but no one is talking about it, and it's definitely worth mentioning. So, what can you do to protect your portfolio from the worst case scenario? Well, you could sell everything, but that might be messy for tax purposes if you've got long-term holdings with a lot of gains in them. What might be better is to take a position in an ETF like VIXY, or the very similar but even riskier 1.5x leveraged UVXY, or the even riskier 2x leveraged UVIX. None of these are for the faint of heart, and none should ever be held for more than a couple days, in my opinion. But if one were ever going to do it, now might be the time. We did a much longer explanation in our SFAL video, but in short, the VIX is known as the fear index, and it spikes up when the market sells off and gets really fearful. You can see that over time, this strategy will absolutely smash you. VIXY is down 99.99% since its inception in 2011. But in short periods of time, when volatility spikes, it can do incredibly well. That's nearly a triple in about 2 months in 2011 during the European debt crisis, more than a double in a couple weeks in 2018 during the first trade war, about a 5x return in a month in 2020, and so forth and so on, all the way to a negative 99.99% long-term return. But it's the erosion over time from the way it's managed that makes it such a bad long-term investment. It doesn't have downside risk like that in one day. If there's a really good outcome on April 2nd and the market rallies, could this be down 10 or 20%? Yes. But if there's a really bad outcome, Could it be up over 50%? Also, yes. And for the other ones, the upside and downside are just magnified. I, personally, don't plan to take a position in any of these because, in principle, I don't buy things that I want to be willing to hold for the long term. And I want to be willing to hold any of these more than a couple days. But the gambler inside me definitely finds that asymmetric upside and downside potential attractive. What I will be doing is hoping for some market volatility, especially if it has to do with Europe or China, because I'm getting way more confident in the long-term outlook for both of them. I'll have to assess what's announced when it's announced to be sure, but I'd likely view any short-term weakness as a buying opportunity. If you want to hear why I'm so positive on Europe and China right now, so positive that almost 90% of my 401k is invested in international equities, hit that subscribe button and stick around for the next video where I'm going to break down why I think we could be entering a major US, non-US regime change. I know it probably sounds crazy now, but it might not after you watch it. And by the way, my partner Kyle and I, we do run a free Discord with over 400 members. If you'd like to join that, just hit the link below in the description, and we'll see you in the next video.